You look at institutional desks around the City of London, you know, especially within retail FX, it is 99% gold flow.
But the Chinese central bank has been a massive buyer.
The headline of this podcast will be $5,000 an ounce by the end of the year.
At some point, not by the end of the year. I reckon.
Say by the end of the year, because it will definitely get more views.
It can go to 5k at some point as long as.
This episode is all about gold. Now, China is buying gold like there's no tomorrow. But why are they doing it now?
And could it send prices rocketing to $5,000 per troy ounce?
We'll dig into how it's impacting inflation, the dollar, the overall economy, and the overall markets.
So if you're new to gold trading or gold investing, you don't have to worry because we are going to unpack everything that you need to know.
So stay tuned because the new gold rush could already be here. Now, I have to say a quick disclaimer. So, this podcast is for educational purposes only and is not intended to be financial product advice or any investment recommendation. Stay tuned for additional disclaimers at the end of the episode.
This is the Market Edge. Let's get into it.
So, the meme of the week is, well, it's a meme that you created.
I made this, yeah.
So this is what happens when we sit there and go, should we find a meme? And you went, no, I'll just make one.
I'll make one.
Yeah.
I think it's true though and excellent. You know, people are always talking about gold being, or Bitcoin, being like the digital gold.
Yeah.
But currently they've turned away from Bitcoin mining stocks and investors are really, really bullish on gold mining stocks.
But it's like we've gone back like 30 years.
Yeah.
You know, gold mining stocks were, I mean, they've always been pretty big business, but yeah, gold mining stocks are massive. But obviously, I think we go into the reason why we're all over gold, right, at the moment. Why this episode is gold focused. Right. Number one, it's at all-time highs. Yeah. You know, pretty much on a daily basis. But I suppose that the thing is we're going to dig into is why is it at all-time highs? Why are people looking at gold mining stocks rather than Bitcoin mining stocks?
Well, more marginal buyers than sellers, James. That's what it always comes down to.
General market.
But yeah, no, there's a couple of factors at play here. Obviously, we've seen gold rallying massively because of the geopolitical risks, inflation's higher. People tend to think of gold as an inflation hedge, which is funny to me because it doesn't actually make any cash flow.
Yeah.
And so I think, you know, we're seeing it from a multivariate perspective here. We're going to get into it later, but the Chinese central bank has been a massive buyer.
Yeah.
And also other emerging market central banks have been big buyers as well.
Yeah.
Many putting it down to wanting to, you know, differentiate or diversify their FX holdings and their, you know, reserve holdings, which I think has merit, definitely.
Yeah.
They've said this themselves. But also I think there are some other caveats to that idea as well.
I want to just touch on something about this whole safe haven aspect of gold, right? Now, we've both worked in markets for years, right? Back when I was when I first started doing this sort of stuff, you'd go on TV, right, and talk about why is gold moving, you know, why is gold going up? And you get Bloomberg, CNBC, all the talking heads, which I was one of. You'd go on and go, when you have no idea why gold's going up, you'd go, oh, you know, it's safe haven moves, right? And it was kind of we're saying safe haven because I've actually got no clue why it's going up. You go, it's safe haven. Because we spoke about this beforehand, right? Gold is considered the safe haven asset, right? Always has been. It's been one of those historical points. For a while, it became particularly, you know, not very fashionable to talk about it as a safe haven. Now, all of a sudden, everyone's talking about it as a safe haven again. But like you said before we started here, safe haven from what? You know, that's the point. You know, what is it currently a safe haven from? US
equity markets are at all-time highs as well. So it's not like you can say, we're in a, you know, if you want to use the term risk-off environment.
Yeah.
We're still very, very pro-risk. But I think it's that elevated inflation perspective. And also, obviously, Trump being very, very bullish across, you know, loads of different foreign governments as well in terms of the tariffs. So I think, you know, they might be looking at it from the perspective of, okay, if we see less dollar flow going in, then that means we can't invest as much in dollar assets. Let's now hedge in gold, which is relatively universal, rather than focusing back on dollar assets like agency bonds, treasuries and stuff.
But if you went to a point and you said, I mean, it could show why gold is so popular. You know, it's always been incredibly popular. You know, you look at institutional desks around the City of London, you know, especially within retail FX, it is 99% gold flow, you know, everywhere. And if it's always been this safe haven, you go, okay, well, it's a safe haven from, fundamentally a safe haven from uncertainty. When there is uncertainty, people fly into gold. Well, there's always uncertainty. When is there not uncertainty? Especially at the moment, right? So I suppose it's almost like a Trump play, because Trump is, in the dictionary, uncertainty. It's a picture of Donald Trump.
So there's quite a nice analogy here. One of the biggest reasons as to why the UK equity market and UK equities perform kind of so badly versus the US, apart from maybe the last 9 months in the FTSE, is because there's lack of real money bid. So real money bid is basically from pension funds.
Yeah.
Pension funds in the UK hold about 2% of their entire asset portfolio in domestic UK equities. And in Australia, it's about 40%, just to show a divergence there between similar economies. And so without that real money bid, assets can't really do much. Now, if we compare that now to gold, and I think I've already hinted at the People's Bank of China has been the main buyer. That is a massive, massive real money bid. And when central banks are buying stuff, it's like QE. You buy bonds when people are doing QE, or central banks are doing QE. It's exactly the same now with this gold trade. You've got India, you've got Russia, you've got China. You've still got America as well, actually buying gold too. Which is something that people tend to forget about. But you've also got other governments around Turkey.
But people want this BRICS versus, the West side, don't they? Because the media is so in on World War III, aren't they? They're so in on going BRICS versus the West, you know. Well, if BRICS are buying gold, then everyone else needs to be buying gold.
They're fully invested in that idea. But the problem is that when you compare the GDP per capita of all of these countries versus the US's, it's like the US is, China, for instance, $12,500 a year GDP per capita. US is $88,000.
Yeah.
Like, there's no comparison. And they're all reliant on the US, which is the irony of the argument.
Tweet of the week. Peter Schiff, now notorious gold trade,
salesman, broker.
Yeah. Sells courses. There's nothing wrong with doing that, obviously.
No, he runs a gold brokerage, bullion.
Yeah, and makes a lot of money out of it.
Yeah, he's good.
Yeah.
Like it.
His tweet. Michael Hartnett, Chief Investment Strategist at Bank of America, is now saying what I've been warning about for years. With the exception of Bitcoin, he is recommending an investment strategy nearly identical to mine: gold, mining stocks, foreign stocks, and emerging markets. Yeah, isn't that everything?
So someone missed out on Nvidia. He's basically saying avoid US stocks.
Yeah, cool.
Which is the irony when, Nvidia, Broadcom, all of these big AI companies are US based and have made the most money over the last 5 years.
And are dominating global market movement.
Yeah.
So great.
Well done, Peter. You're really, really clear on your bias there.
Yeah.
Look, I like people with conviction behind their ideas, so I don't. I don't crap on him.
Yeah.
He's a big.
You've got to nail your colours to the mast.
Yeah,
right?
He's a big gold bug, and he's winning right now.
Yeah, exactly. Yeah. But gold, mining stocks, those two, that could be the case for the last 30 years, 40 years. Foreign stocks, I mean, that's like, what's foreign to everything else?
Foreign.
Yeah, foreign stocks.
just blanket. Let's go buy Russian stocks.
Yeah, foreign stocks.
Have you
What's
got
it mean everything else apart from
Have you got
US
a
stocks?
bid in a Uzbekistani pig farmer?
What should I buy? We'll just buy foreign stocks?
Yeah.
All right, brilliant.
It's a
Cheers,
nice basket.
Pete. Cheers, Pete. And emerging markets. So isn't foreign stocks and emerging markets the same thing? Anyway, cheers, Pete. Excellent. Now, we're looking at this gold focus. I'll let you take this because you know about it.
Yeah, so this basically showing the chart on the left is showing the amount that the Chinese central bank has been, or actually China in general, but probably more specifically the Chinese central bank here.
Yeah.
It's probably about 80 to 90% of this flow. How much their gold buying has ramped up. So a lot of the demand has come from China. And then conversely, this chart is showing house prices in blue, gold price in yellow, and dollar yuan price in orange.
Yeah.
And you can clearly see that as the dollar has weakened versus the yuan, you're effectively seeing an increase in the gold price.
Yeah.
So for China,
but then dollar weakness, gold up.
For China, it's effectively a gold dollar play. You're long gold, short the dollar. Yeah. So that's what their play is really. But
people are taking money out of property and putting it in gold.
Yeah, but you can see there that as I guess the gold price has strengthened, people are now saying, "Oh, I don't really want houses as much." I think that's a bit of a spurious
Yeah.
correlation, though. I think the FX basis there is much stronger than the housing price one.
And plus housing, you've got a lot of other factors at play, right? Economically, right, that get involved.
And policy basis as well. You know,
Yeah,
they're trying to reduce leverage. You know, they had a massive clampdown on
Mm.
land speculation in China. So it's I don't really understand the need for that blue line there.
We always talk about we talk about trading gold. We got to look at a bit how you trade gold and what you trade on, right? Because you've got situations of if you said to someone, general retail investor, go and trade gold, would someone know you have to go and look for XAU US dollar, or you look at a gold future, or you can trade gold mining stocks, or how do you invest in gold? That's the key thing, because I'd say the majority goes through the currency pair version, right? The metal pair gold US dollar, right? Which they all are, but when you're looking at a trading platform, you're looking XAU US dollar.
And CFDs anyway.
Yeah.
For sure. I think retail brokers have done such a fantastic job of marketing their commodities CFDs. I think most retail investors now would say XAU before they'd say, GC, which is the CME futures contract.
Yeah, GC1, yeah.
Or they wouldn't know about GLD, which is gold ETC.
Yeah.
Or they might not even think of going and buying gold bullion now. It'd normally just be, I'm going to trade XAU USD.
Yeah.
And there's slightly different products, XAU USD tends to be a derivative of the CME future.
Yeah.
So it's a derivative of a derivative.
Nothing complicated there.
Whereas ETC is, exchange traded.
Yeah.
Commodities have to be traded in a, slightly different way to an ETF. But look, there's various ways to access, and it depends whether you want leverage or not, really.
Yeah, most people do want leverage. So trading on leverage
because they're mental. That's why.
Because they're nuts. Brokers love it. Cut that bit.
No, you can keep that in.
Let's look at some of the charts. So we'll go through some of these trading ideas and we'll cover off a few of those bits of what we were talking about. So if we look at XAU, is one of these charts XAU, do you reckon?
I think we've got GC in there. It's gold
GC.
futures, basically the same thing.
Yeah. So the gold price. What you'll find when we look at all of these charts is they're all pretty much doing the same thing, right? Because they're all pretty correlated, which you can understand that if XAU versus the US dollar, which is basically a spot gold price, if that's going up, then the gold future's going up.
Yeah.
Then if gold futures and spot gold are going up, then the ETC is going up, and if the ETC is going up, then it means that gold mines are going up.
Probably,
fundamentally, it's all going to stay the same.
I think, so I bought Barrick a couple of months ago now.
So Barrick's a big gold mine, right?
Yeah, huge. You've got Barrick and you've got Newmont, which are the two biggest ones.
Yeah, and we've got these two charts here. So.
Yeah, and I bought them basically off of their off of the copper price actually moving, because they're a big miner in copper as well. Yeah. But obviously, interestingly, since then, the gold price has started to rocket again. Now, I prefer actually buying the miners over the commodity itself.
Yeah.
Mainly because with the commodity, you don't get cash flow. Yeah. You don't get dividends.
Yeah.
You don't get necessarily a board that's motivated. What you're actually trading on is, I guess, the macro picture.
Yeah.
And the macro picture is far too uncertain consistently, and there's too many things to have to price in, versus a company where the CEO goes and tells you, we're expected to do X amount. We've got this amount of orders next quarter.
Yeah.
We're doing this amount of mining, and we know that we can sell it for this amount because we've hedged Y amount.
Yeah.
It's much more certain and a much better business case to then say, okay, well, the stock is underpriced by 10%, say.
Yeah.
So that's why I prefer to look at the miners more than the actual price. But
you won't get the basket case moves in the miners either, right? Like you won't get.
Look at that.
Yeah, exactly. Yeah, and what do we say? What we've been saying for a year, up and to the right.
It's all that matters.
Going up.
And look, if you look at that chart, it's approached a 52-week high. 52-week highs should always be bought if there's momentum leading into it.
Yeah.
Because it's likely to go higher.
I'm telling you now, right? So just to go back, when I used to trade years ago on the desk, we literally used to go, and I probably said this before, there was a software, obviously, and the software was rubbish back then, but, You go in there and you could just filter everything in your list by what's hit new 52-week highs on a daily basis, and 3 or 4 stocks will come up. You just buy them pretty easy.
Yeah, I mean,
Buy and hold them.
It sounds like a really, really simple strategy, but once you understand the different factors involved, you've got momentum there.
Yeah.
You've got the fact that, yes, algos these days will kick in.
Yeah.
You've got the fact
doing exactly that thing.
Yeah, you've got the fact that weaker hands are likely to think, oh, it's at a 52-week high, let me sell now, because it's not going to go higher, is it? You're not trading FX here, which is very mean reverting.
Yeah.
You're trading a business. And a business that has seen its price go, from below its 52-week high back up to it. Why does it mean it's going to reverse there?
Yeah.
It doesn't. It means that it's going higher because expectations for next quarter are going to be higher.
Well, it's interesting, isn't it? Because the retail trader, we were taking the piss out of our producer yesterday in our production meeting, right?
Yeah.
Because as soon as we said about doing gold, talking about gold and the market moving and looking at these stocks, his instant reaction was, they've been going up too long, I can't buy them.
One of the really funny things is that I tend to take a signal. I've got quite a quantitative model that I focus on to screen out for momentum and stuff like that. And one of the interesting things is once it's screened, I effectively consider that the very, very, very start of its entire price history.
Yeah.
From that one signal. So basically, if you think about it, the rest of the chart just gets deleted.
Yeah.
Because then what that does is it allows you just to focus then on that specific signal and forget about the bias of what's happened before.
Yeah.
Because it's absolutely, key to avoid those biases in terms of, thinking, oh, it's gone up so much, it can't go up more. If you'd have thought that about Nvidia as an investor and you'd have bought
well, you look at all of the things you could have done.
Well, exactly.
All of these stocks, Apple and,
but it's
that Mag 7 stocks, pretty much all of them.
It's the sheer bias of uncertainty, isn't it?
Yeah.
It's just people, they're so afraid of not knowing what's next that
but then there's always this old adage.
Comfortable in certainty almost.
Yeah, exactly. So if we were looking at gold now and we look at where we go in the next, I don't know, towards the end of the year, I suppose that's our focus. The headline of this podcast will be $5,000 an ounce by the end of the year.
At some point, not by the end of the year. I reckon.
Say by the end of the year because it will definitely get more views.
It can go to 5K at some point as long as China keeps up the buying. But
we're 3.6. Yeah, we're about 5, something like that today.
About $1350, $1,350 away from 5K. So it's a very, very long. It's a very long way to go.
So where do we look at? Not to give any advice here or predict where we're going. This is going up. It's strongly going up. But there's so many factors within it, and if we were to look about what's going on towards the end of the year here, we have to look at gold has so much focus around, knee-jerk reactions, uncertainty and all of those things. It's a bit of a basket case. Even though it's going up, anything could derail this at some point. But the only things that you can see are tariffs aren't going anywhere. Uncertainty around conflict isn't going anywhere. So likelihood is it's much of the same, right?
Yeah, I think, as I mentioned, unless that bid from China goes away, it's going to keep going up. I think it's every month they basically will have a report out, I think maybe from the World Gold Council or something like that, that will refer to Chinese buying. And when you see that dry up, it's probably the time to, reduce some risk. But Trump's got another, 3 years roughly left? So
when's midterms?
Don't know. Don't pay attention.
Middle of the term, probably. Whenever that is.
So I think that's the key factor to watch. I don't like bringing too many variables into things. Cause it's just pointless. You'll see it when the price starts going down. It's probably the time to get out.
Yeah. You heard it here first. Yeah. So if you agree, disagree, and think we're talking rubbish, then let us know. Like, subscribe, comment, whatever you like. This podcast is for educational purposes only and is not intended to be financial product advice or investment recommendations.